This is just a quick video to answer the questions that you guys have been posting on the blog and the socials. Now the question we're going to look at today is about currency crosses. So for example, a major currency pair would be anything that involves the US dollar. So for example, pound dollar, euro dollar, you get the picture. A cross is something that basically doesn't involve the dollar. So for example, pound versus Japanese yen or pound versus Australian dollar would be classed as a cross. Now the question is, how does trading crosses relate to those majors? Is trading, for example, the pound US dollar, so buying the pound US dollar and selling the Australian US dollar, those pairs, is that basically just the same as buying the pound Aussie cross? Well, there's two answers to the question. The first answer is generally it's very similar, but it's not exactly the same. And the simple answer to why it's not exactly the same is because you've got a third currency involved, and that's the US dollar. So for example, if there was a really big move on the US dollar, let's say the pound Aussie cross is going up, okay, that's bullish for the pound, bad for the Aussie dollar. But if we get a really strong sell-off on the US dollar, then both the pound dollar and the Aussie dollar are going to go up. Okay, so it's not as clean cut as just trading the cross itself, because you've got the third currency of the US dollar involved. So if you want to trade the crosses, or the best way of describing it is if you've got two central banks with clearly diverging monetary policies, so in this example the Bank of England and the Bank of Australia, the Reserve Bank of Australia, then you'd be better off trading the pound Aussie cross pair. It's a lot more volatile, of course, generally, but you're going to get a much cleaner move on that central bank policy divergence. Whereas if you try and trade the US dollar pairs, it's not going to be as volatile, and you're not going to have to risk as many pips, and obviously you won't make as many pips, but the fact that you've got a third currency in there does kind of make it not quite so smooth flowing and not quite so simple to trade. So the concept behind cross pairs is just basically gives you the ability to match currencies purely, and it's not quite the same as trading the dollar variations, and that's basically why. So I hope that's explained that point. It's a very simplistic explanation, but that's generally the way it works. I'll be back soon with some more videos. And again, if you've got any questions or comments, anything you'd like me to cover in the videos, please let me know. Keep posting on the socials.